Welcome to Chapter 9. Here we're going to concentrate on several topics. One is decentralization, and the other is how we use this to evaluate performance. So if we move on to slide 8, what we're going to be talking about is using accounting information to help us in performance evaluation. We're going to help control operations. We're going to evaluate performance. We're going to allocate our resources, and we're going to plan our strategy. So if we look at slide 9, we introduce several concepts. In fact, in slides 9 and 10, we will introduce 3 concepts: the cost center, a profit center, and an investment center. A cost center is typically at the lowest level of the company, and that is where costs are collected. Now, a profit center is one where costs and revenues are collected. So if you think about it, a cost center is usually at the supervisor level. A profit center is usually at a product level, meaning we're now moving up the organization hierarchy. So a cost center is probably the junior level managers. Profit centers, since at this point, the manager is responsible for both profits and losses and costs. The profit center is now what we would consider middle or upper management. And then in slide 10, we introduce the concept of the investment center. And here we're talking pretty much at the CEO level or the division head, because we expect that the CEO or the division head are responsible for not only costs, profits, but also investments. And what we mean by investments are buying or building plants, buying machinery, the types of long-term investment decisions. So if we then move to slide 11, we're now going to be talking about how do we allocate departmental expenses? And again, going back to some concepts we introduced in Chapter 1, direct expenses are those that we can tie directly to a specific department. Indirect expenses are those that benefit more than one department and therefore need to be allocated on some basis to the producing departments. If we then move to slide 15, we're going to look at here what do we use as our bases for allocating service department costs. For example, we have an HR department. So one way to allocate the cost of HR departments is on the number of employees. We have a maintenance department, the janitorial crew that comes in and cleans up at the end of the day. Well, we could allocate their cost to the number of square feet that each department occupies, because that's what the maintenance and the janitorial departments do. They clean up square footage. So you get the idea on the almost the common sense approach that a manager would use to come up with allocation bases. Now, if we jump ahead to slide 20, we're going to look at the direct department or direct expense allocation to departments. So we have payroll, and that gets allocated to all the departments based on salaries or number of employees. We're given the depreciation expense, and this supplies. Now we move to slide 21. We look at the indirect, and now we have the utilities, which could be allocated based on floor space or janitorial. We would take and calculate out the floor space, and then based on the percentage of floor space, we would allocate the total cost. Okay, so now we've done all this. So why do we do this? Why are we going to allocate all this? Well, we get to slide 26 and we start getting now to the real meat of this chapter. And you've all heard the term ROI, which is return on investment. It is a measure of profitability that allows us to look at an investment center's net income divided by its average total assets. That gives us a percentage number, and we can use that percentage number to compare historically within our business or to compare ourselves to others in our industry. So ROI, real crucial concept. Now, before we move on, I'm going to jump a little bit out of order, and I want to go to slide 36 because what we're going to find is there are two components of the ROI. First is the profit margin, and the second is the investment turnover. And if we move to slide 37, we'll see that the profit margin is the net income divided by sales. That gives us a profit percentage and tells us how profitable our sales are. If we go to slide 38, we'll see the investment turnover, which is sales divided by the average assets. And you'll notice if you combine the two of them, the sales eliminate out and you end up with the original ROI formula of income over assets. Now, the reason we break out the ROI into its two components is that we're very interested in knowing whether our performance was better or worse than expected. Was it due to a profit margin aspect, or was it due to our asset utilization, which we call the turnover? So now let's back down to slide 27. And here we're going to look at several other concepts that we need to take into account. One is the residual income, because the ROI is going to give us a number in percentage terms. The residual income is if we look at our net income versus our target net income, we subtract those, and that tells us by how much our net income exceeded our target. And we do that, that gives us a dollar term. Some people like dealing with dollar terms. I can tell you the industry practice is predominantly to use the ROI, the percentage measure. And then if we go to slide 28, we look at the balanced scorecard. And here we're introducing a concept that says it's not only significant to look at financial measures, we need to examine non-financial measures. What do I mean by that? Well, let's look at the hotel industry. I could sit there and look at a hotel and I could say, wow, this hotel had an ROI of this, or it made so much money. But I could look at a non-financial measure pretty quickly and determine whether a hotel is doing well or not. And when you think about it, one of the economic indicators you read about all the time is hotel occupancy rates. Well, if I know that a hotel here in San Diego is running at a 75% occupancy rate and break-even occupancy is 60% occupancy, then I know that my particular hotel must be very profitable because it is significantly above the occupancy, the break-even occupancy rate. So notice we're back to that term break-even, which takes us back to Chapter 5. And again, so remember, the whole purpose of balanced scorecard is we want to be able to have both financial measures and non-financial measures with which to measure our performance. Finally, then, we go to slide 34, and the whole purpose of this chapter then is to get us back to a concept called management by exception. And what we do with management by exception is that now we have all these performance measures, we compare them to one another, we compare them to our past, and now management then will concentrate on those areas that are significantly different from expected results. Therefore, if we thought we were going to have a 70% hotel occupancy rate and we ended up with 70.1, there's probably not much you need to do to manage that. In other words, what we're saying is that we want management to concentrate only on those items that significantly vary from what we expected. So, to summarize again in this chapter, what we've looked at are establishing cost centers, profit centers, investment centers, and then establishing an ROI to be able to measure the performance of our investment centers against a variety of techniques or companies. And then secondarily, we establish balanced scorecard, non-financial measures as a way of also measuring our performance.